Hey guys, welcome back to Evolve or Die. Today we're going to be talking about the differences between trading and investing. There are some key differences that I want you guys to take away. Remember, in my first few videos, I talked about before you dive into this, before you start trading stocks, before you start looking for companies to invest in, you need to be asking yourself about what are your goals? Are you looking for long-term annual returns? Are you looking for dividend payouts? Are you looking for, rapid scalping of profits through different types of trading around a core position, swing trading, day trading? There are some things that you need to have in mind before you dive into this. And I personally like to think of investing versus trading as investing is the art and trading is the science. I like to think of the different mechanisms that are taken into account to be successful at trading are not always the same as long-term investing. So that's going to be the focus of today's video. Hit that subscribe button down below, you guys. Make sure you turn on the notification bell. I'm going to bring everybody on the money trail, even though I'm not a financial advisor and this is not financial advice. Everyone should be doing their own due diligence and their own research. I'm just here to share knowledge with you guys as I acquire it and share, like I said, some of my own personal findings and my own approaches to different things. And yeah, so let's dive right in, you guys. Investing and trading are two very different methods of attempting to tackle the financial markets. So they both have the same end goal, which is to rack up those capital gains. However, the approaches are very different. If you're an investor, your primary goal is the seeking of long-term greater returns over a fixed amount of time, whereas trading, the focus is to take advantage of rising and falling markets. This is where trading options, puts and calls comes into play. And you're taking advantage of rising and falling markets to enter and exit positions over a shorter, smaller time frame and much more frequent profits than the long-term investing takes a much more long-term approach, whereas trading involves a very short-term, monthly, quarterly, annually approach to maximize those returns during those fixed intervals of time. So investors are much more likely to ride out losses. You won't see very many long-term investors setting stop losses because their objective is to pretty much ride the wave throughout all of the rises, all the peaks, all of the downtrends, all of the uptrends, the downtrends, the whole cyclical markets. They're basically going to hold through that because their focus is not the quarterly, monthly returns. Their focus is on that long-term return. I do take both approaches to generating revenue. However, I think the approach that's best for people beginning is to study how to invest, study how to find value in companies, study how to look for those companies of tomorrow that are, like we talked about yesterday, going to propel society forward. I think you need to be a good investor before you can be a good trader. I have learned that. And like we talked about, investing is the much a more long-term approach. It's the, we're in this for the marathon. This is not a sprint. Trading is more of the very frequent entering, exiting of positions, scalping off profits. Just much more frequent transactions is the key difference. Buying and selling stocks and commodities, currency pairs. And the goal is to, of course, for investing and trading, to generate profits that outperform buy and hold investing. So the objective of trading is to outperform those who are holding long-term positions. And you'll see a lot of other YouTubers that talk about how they've scalped, 100, 200, 300% returns in just a couple of months. Whereas you might have some long-term investors who are invested in ETFs that might give you a compounded annual rate of 20% returns every year. So, but again, it all comes down to what your own personal goals are and what your own financial risk tolerance comes down to. Like, you need to be having a very clear vision of your risk tolerance and your risk management before entering into any position. So part of the mindset that you need to develop before going into this is how to view the stock market. The stock market is not Disneyland. It's not Candyland. It's not this happy-go-lucky place where, oh, we're all gonna go make money. You gotta change that approach. The stock market is a brutal bloodbath. The stock market is comprised of a bunch of institutions and hedge funds betting that you're going to lose money. The stock market is designed for regular retail investors to lose money. It is rigged against us, not in our favor. So you need to have that in your head before going into this. Like, this is a skill-based, IQ-based, mental capacity driven money market. This is not Candyland. So you need to have that in your head before even making an attempt, because a lot of people have this misconception that it's there, equal opportunity. And it is a playing field for all players to enter the market. But most people go in and they're temperamental, they're emotional, they make bad decisions, and the hedge funds keep getting richer because retail investors enter and they don't know what they're doing. We talked about, you need to have some kind of risk management established. You don't want to be investing any more than you can lose. That's the golden rule. That's the most important thing to have in your head before diving into this is don't invest more than you can lose. Don't invest your rent money. Don't swing trade your utility bill money. Don't do that, because again, we're all about risk management on this channel. We're not I'm not into the high risk plays just yet. I have developed my own strategies, and I've studied a lot of other great investor strategies. I've studied a lot of mindset theory before going into the market. I've studied a lot of different trading mechanisms, and I've understood a lot of the market mechanisms before attempting this. And personally, I don't take positions in things that I think are high risk plays, even if it's a short swing trade. I've developed my own strategy and I've developed my own style of trading. And that's what I encourage all of you to do. I encourage, please study as many different investors, study as many different trading strategies as you can find. Like, it's going to be invaluable in developing your own method, but that's going to be really the key to being successful. That's what I learned early on. Like, if you try to mimic other people's strategies, if you try to mimic other people's way of doing things, if you just try to replicate what you're learning, if you just try to repeat and recycle and clone what you're learning other people are doing and what works for them, that might not work for you. That might not be your style of trading. That might not be your strategy for your risk tolerance. That might not be the approach that's good for your financial needs. So I do encourage doing a lot of research. However, it's an art, like we talked about. It really is an art. It's a psychology, it's a science, and you really need to develop your own flow, your own momentum, your own rhythm while approaching this. And I'm gonna have a video for you guys about how I developed my own strategies and some of the resources that helped me develop the approach that I take when entering a position. And like I said, I do actively trade and invest, but they are two they're two very different forces. So keeping that in mind, you guys, there are two different arts and sciences, the art of investing and the sciences of trading. So I'm gonna have more for you guys regarding specific trades and specific different market mechanisms that I analyze before making trades, and the key components that I'm looking for when entering a long-term investment position, which we kind of talked about in my video yesterday. I'll leave a link down to that below about how I pretty much changed my psychology before I approached investing, and how I got into a very specific frame of mind to enter the market. And it does require a certain foresight and insight into where the future is going, to find those lucrative companies, to find those lucrative, profitable investment opportunities. So, like I said, they are different. They're very different forces, and we'll talk more about the specifics, strategies, and different approaches that I take on the next episode. So yeah, guys, the book for the week is still Holographic Universe. It's a great read. I'm about halfway through. If any of you are interested in the metaphysical world, and how we're all interacting with the world on a vibrational level, it's the most fascinating book I have read in a long, long time. So you guys should check that out, The Holographic Universe by Michael Talbot. And again, I'm going to post all of my referral codes down for Robinhood, Webull, and a link to my NFT markets. So yeah, guys, thanks for tuning in, and I'm going to have some more uploads for you guys later in the week about very specific trading strategies that I use and very specific investment strategies that I use. So thanks for tuning in, guys. Keep evolving.